Okay, take it. We're good to go. Um, my name is Carleen Gaskin. Just want to thank everybody for joining. We're here to try and help everyone get a basic understanding of some general business valuation concepts. Just to give you a little background about myself for any of you who are don't know me, and that hopefully we meet up again soon. But I am the team leader of our matrimonial litigation department in our forensics valuation and services group here at Withum. I have about going on 22 years of experience in the forensic world and been with Withum for about 11 of those years. I have one of my senior managers presenting with me today, Judy Doyle. She is a CPA also and certified in financial forensics. She works mainly out of our Red Bank office and has been with Withum going on just about 3 years now. And Jasmina, who is another one of my managers in our matrimonial litigation group. She works with me up in the Saddlebrook office up in northern Jersey, and she has been with Withum for about 5 years now. That's pretty much a basic background of who we are. Today, first, I would just like to take care of a couple of housekeeping items. We do have some attachments for you to download that should be in the GoToWebinar information box that should be on the side of your screen, so please download those when you get the chance. And there will also be some polling questions along the time period of our webinar. You must answer all of those in order to get full CLE credit for today's course, so please do so. I believe we should be given about a minute to answer each of those questions. At this point, just to give you a general idea on what we're going to cover today, we're just going to go over a few of the most common areas where there can be discrepancies between valuation reports. If you're not very familiar with valuations, we are going to cover some basic definitions and general descriptions of how business valuations work, mostly for smaller companies. And along the way, I believe, and Matt, who is assisting us with the webinar here, I think there is a spot for you to type in questions along the way if you did have some, but we're not going to get into very detailed topics of business valuations. If you're not familiar, there are a lot of different areas and approaches that need to be considered if you're doing a full valuation report. We're just going to touch on some of the main areas for you to focus on when you do have valuations to review in some of your cases. So at this point, I think we're going to basically start off discussing the various different types of approaches that should be considered by any expert that's doing a valuation. So I'm going to talk about the asset approach. For the most part in matrimonial litigation, we deal with a lot of closely held businesses, many of which are actually family owned and on the smaller side. So the asset approach is less likely to be used and much less common in my experience. So if you're not totally familiar with it, that's okay. For the most part, you should just really understand that it's based on the balance sheet of a company, how many assets the company has, what the liabilities are. And if it's going to be something that's considered an evaluation, your expert should review those and make sure everything is adjusted to what the current value is. Make sure everything first is reported on the balance sheets, because again, if we're dealing with smaller companies, they may not even maintain a complete balance sheet. So that's really the main concern that you should look at. If somebody's going to rely on this approach, you want to make sure that the company's balance sheet is complete and that the assets and liabilities have been reviewed and are adjusted, such as receivables and payables, and they do represent accurate values. One of the things to look for, to make sure that things like that have been done and considered would be if balances have stayed exactly the same from year to year. The likelihood of that being accurate is probably slim, and it means that something wasn't reviewed or adjusted, and it's probably not a current value, and it may not even be relevant. This approach you would most likely see this being used in more of asset heavy companies, large construction companies that maybe own a lot of equipment, something like that, where there's actually hard assets that would be able to be sold. Obviously, on the other side of that, you want to make sure that all debt is accounted for any of those assets that are owned. One of the last things you should probably also look for is, are there buildings and possibly land that's reported on the balance sheet that may be owned by the company, but one of the questions that you want to make sure your expert addresses is that property relevant for the business operations, or should it be something that's handled separately? So that would be a consideration that you would want to look at. This value, if there is a value, it would be probably close to what sometimes we call book value. And sometimes a lot of people like to think that it's really the floor value of a company. It could be close to maybe what the liquidation value would be if you're going to sell all the assets and pay off all your liabilities. It could be an indication of value, but again, it's not the most commonly used, especially for service business. But it should be something that should at least be reviewed and considered by your financial experts. And they should be able to explain why they're using it or why they're not using it. So since it's the least common approach, I'm not going to spend any more time on that at this point, and I'm going to pass it off now to the market approach, where this, depending on the size of the company, can be very useful because you can have market transactions, which basically we like to compare you can compare it to the sales, say, of homes as the most common analogy to use. If you sell a home, how many bathrooms does it have? How many bedrooms does it have? Is in the same area? Is the same size? And you use comparable transactions along the way to determine what your house should sell for. We do the same thing in business valuation. We have a lot of different industry statistics and market comparables that we can pull up in our databases to see if we can use comparable information to see what a business might sell for in a public market. One of the things that you need to be very careful of, though, is the accuracy of the data and the reliability of the data as compared to your company. There's a lot of specifics in a sales transaction that you have to make sure that you're reviewing the details of these market databases to make sure that the data is actually comparable to the company that you're valuing. You want to make sure it does a similar service line. Is it about the same size? Is it in the same area? Which would be the main parts. But what can make these transactions tricky is actually the details for the actual sales transactions that occur between a buyer and a seller. You want to be able to know how much was paid up front for a business, how much was financed over a number of years. Was it an asset sale? Was it a stock sale? The term of any agreement, all of these are relevant to determining what the current value of a company would be. And if you use this information improperly, it could give you basically a bad indication of value. A lot of times, because you have really small companies, if you're dealing with family-owned businesses, you're going to find that these transactions may not be comparable because a lot of the databases rely on public company information or companies that are much larger and more freely saleable in a public market. So you want to just make sure that your valuation experts consider all of these details if they're going to rely on this approach. The third approach, and probably the most common in the industry that we deal with, is the income approach. It's just like it sounds. You want to determine how much income a business generates and what the available profitability of that company is, and is it expected to continue in the future. One of the key points to business valuation to remember is that you're going to be valuing the income that a company is expected to generate moving forward, not what it has generated historically, because you can use that as a benchmark. But if you're going to come in and buy a company, you want to be able to predict that you're going to have some profits moving forward. That's what you would be willing to pay for. So under the income approach, there are two methods that are used. One is the discounted cash flow, which is a projection of ongoing incomes for companies that maybe are a startup or not stable. There might be some anticipated growth going forward or some expected changes. Maybe the company is going to downsize and it's not at a stable point in its business life, so you would want to do a projection. The other method is called the capitalizations of earnings method, and that's if you have a stable company, it's been in business for a while, there's no anticipated major changes going forward, and you think that what it's earning now is a pretty good indication of what it's going to continue to earn moving forward. The The income approach is probably also the most common for the family-owned businesses, because it's really kind of gives you the indication if whether or not the owners are making a profit, or if they are making more or less than reasonable compensation, and that kind of gives an indication. What we say is there any excess earnings into the business? The people own more than a job. That's kind of what you want to determine if there's a value to this asset in addition, that could be subject to equitable distribution. So that's really the crux of what you're trying to get down to valuation when you're looking at the income approach for value. So I think at this point, we're going to focus on the income approach, since those two methods are what are used most commonly in divorce cases with the family-owned businesses. And I'm going to pass it off to Judy, who's going to go into much more detail about that approach for our example purposes.
Okay, thanks, Carleen. Hi, everybody. So like Carleen mentioned, most of the presentation today, we're going to discuss the income approach. So as she said, it's the most common when valuing small, closely held businesses. So the majority of the cases that we're focusing on in the New Jersey, matrimonial cases, you're most likely going to see the income approach used. Not to say that there aren't cases that won't warrant the asset or market approach. Every case has unique facts and circumstances, but for various reasons, the income approach is most often relied on for these small, closely held businesses. So the basic concept to the approach is that you're calculating the future cash flows of the company and applying a discount factor to that income stream in order to calculate the present value at a date certain. So most oftentimes that's going to be the date of complaint for matrimonial matters. So the fair market value is essentially equal to the present value of the future benefits. I think Carleen also mentioned there's two methodologies that are used. So there's the discounted cash flow model, referred to as the DCF, and you've probably heard this mentioned more times in the last 6 months than you had heard before due to COVID. Jasmina is going to talk about that a little bit later in our presentation. And then we have the capitalized cash flow method. So those are really the two methods utilized. I'm going to walk you through the capitalized earnings method. So that's really the more common method, probably the method you've seen utilized in the types of cases that you're working on. It's really used when the subject company's future earnings aren't expected to really deviate from what they had been in the past. So I included an example in your materials, Matt, if you wouldn't mind putting that on the screen so that I can kind of walk everybody through the mechanics of how that valuation works. Okay, so we begin by reviewing historical data. So this is really done to determine what you're expecting the future cash flow to be. You're looking back to gain an understanding of what the company has done in order to predict what's going to happen in the future. Carleen pointed that out, but that's very important that you're anticipating what's happening, even though you're reviewing these historical figures. So we have ours here, if everybody can see. See here, you should have ABC company capitalized earnings method on the screen, and reported on the tax returns is the number we start with here. So we have income in year 1 of 50,000, year 2 70,000, 75,000, and so on. And again, everything in our material is for illustration purposes only, so we don't want anybody coming back to us with these numbers. So the first step is to normalize the earnings of the business. And you've probably heard the term normalize before, but I'm going to explain a little bit more about what that means. So sometimes business owners deduct expenses on the tax return that aren't necessarily required business expenses. So they don't need those expenses for the ongoing operations of the company. So you have to make adjustments, or what we call normalizations, to quantify the true cash flow generated by the company. So the first would be any non-business items paid. So those are sometimes referred to as perks. A lot of times business owners of closely held businesses pay for personal items, maybe auto payments for the business owner or their family, telephone expenses, personal credit card charges, travel expenses. So all of those items are deducted for income tax purposes, but they aren't necessarily expenses of the company. And we find those through looking through the general ledgers, having interviews of both of the parties. So we quantify that and add back the perks to normalize the reported earnings. So in the example here, we're keeping it very simple today. We have $5,000 per year in perks. Okay, and then next we're going to add back any non-recurring expenses. So those would be various different things, but basically anything that's not normal or, you know, for the operations of the company. So a large professional fee, if there was a lawsuit and they had to pay out, you know, maybe some startup expenses, you know, again, looking through the underlying records would really shed some light on how we find those items. So once you have your normalized earnings for the historical years, you next determine the weighting and how to weight that earning stream. And that requires like an analysis, a determination as to what you would expect to occur in the future. We're going to get into later in the presentation a little bit more detail. So for now, I just want to point it out. I'm going to hold off on those discussions until we get to that part of the presentation. But in this example, we assume, so we have a weighting of 5, 4, 3, 2, 1. And what that means essentially is that we are year 5 and the earnings that we're finding in year 5, we're anticipating to recur 5 times more than the earnings in year 1. So this example is not a straight average. We're placing more on the current years. And Matt, if you could just turn to page 2 of this example so everyone can see. So from there, the weighted average normalized pre-tax income, say that 5 times fast, so 430,000 that we have in this example, then gets adjusted for reasonable compensation. So we add back the actual compensation paid to the owner and we deduct a reasonable compensation. Again, that requires a lot of analysis. We're going to go through a little bit more later in the presentation. One thing I do want to point out is that the higher the reasonable compensation, the lower the value. So that's a key point that I just want to make you aware of. So next, what we do is we tax affect the earnings. The tax rate applied can vary. Each case, like I said, has unique facts and circumstances, and you know why experts may choose a different tax rate. We'll walk you through some of that, but I just want to point out here that that income stream has to be tax affected. So once we've adjusted the weighted average normalized net income for reasonable comp and taxes, we then apply a growth rate. And this is the growth rate into the next year. Oftentimes it's based on the inflation rate. So after applying the growth rate, you arrive at your expected future after tax earnings. And that is the figure that you're capitalizing for valuation purposes. The next step is calculating a capitalization rate. So what is the cap rate? You have probably heard of the cap rate, but the cap rate is basically the rate of return on your investment. So you think of it as an inverse multiple. So in this case, we have a cap rate of 20%. So essentially, we're estimating the company's worth 5 times the annual cash flows calculated. And the higher the cap rate, the lower the value. Again, something else to point out, and we'll go through that a little bit later. To get to the cap rate, so we typically use a build-up method to determine the cap rate. We look to various research to determine the underlying components of that. We start with a risk-free rate. So 20-year US Treasury bond, that's your least risky investment. Currently, I think it's like less than 2% currently. Then what you do, you add in your equity risk premium, which is the risk associated with investments in equity instruments. Then there's a small stock premium. So there's additional risk with an investment in a small, closely held company. So investing in smaller businesses is oftentimes much more risky than if you're going to, invest in a large publicly traded company. So there's added risk for that. The only subjective component to the cap rate is called the specific company risk. And this is really the business appraiser's assessment of a lot of financial and business risks. And what you do, you then adjust the gross to arrive at the cap rate. I mean, we could have a seminar strictly on the cap rate. It's very complex. There's a lot of analysis that go into it. And unfortunately, we just don't have the time today to get into the detail, but that's kind of a broad overview of the mechanics as to how the rate is calculated. So if we go back to the example, in order to calculate the value, you would divide the normalized future benefit streams, or $169,000, by the cap rate, which is 20% in this case. And that gets that's the indicated value of 100% interest in this subject company, which is, in this example, $850,000. So I know that was a lot of information to take in. I can't see you, but I hope your eyes aren't glazed over or you're not just scrolling your Instagram feed. If you have questions, put them in the chat box. If we have time at the end, we'll do our best to try and answer the questions. Now I'm going to pass it off to Jasmina, who's going to talk about the DCF methodology. But first, I think we have our first polling question, Matt.
Yes, let me get that teed up here.
Okay.
Okay, sorry about that. The higher the capitalized rate, the lower the value. True or false? And once again, please be sure to vote in this, as we do need to, you do need to have that in order for the CLE credit. Are you seeing the poll right now? Just put in the chat box. Okay, thank you. I wasn't seeing responses coming through. We are at about 65% right now, and we'll be closing this out shortly, so please try to get those votes in. Okay, looks like it's slowed down.
Yay, all right, people are listening. 85% said true, so all right, good job.
Let's go back to the, Jasmina, you want me to go to the slide or the example?
Yeah. Go to the next slide.
Okay, not a problem.
Next one. I think we have to go up a couple. I think it.
Oh, here we
There we go. Yes.
There we go. Okay, hello everyone. I will be giving you a brief background on the discounted cash flow method of the income approach. So the DCF is typically used when the expected future earnings of a company cannot be represented by a single period, like we just did in the capitalization of earnings method. So in the capitalization earnings method, which Judy just went through, we came up with a weighted average for the prior 5 years, and then we had that single period, and that's how we determined the value. So in the DCF, we can't do that because for whatever reason, the future expected benefit from the company is expected to change. So whether that's, for example, a company that's introducing a new product line, their sales may be increasing significantly over like a period of 3 to 5 years, and then it's going to level off and be stable. And that's the new normal for the company. So because the historical financials and even the current financials of the company are not expected to align with the immediate future earnings, we have to do something a little different. We obtain projections. So either we obtain projections from management, or as the experts, if the information is available, we create the projections ourselves. Now, with a lot of small, closely held businesses, management don't typically prepare projections, and they don't have the information to prepare the projections. But in this instance, let's say that we do have the projections to prepare. Before we get into what we have to do with the projections, I just want to note that the future benefits that we're going to be projecting is always cash flow. So just like Judy made her normalization adjustments in the capitalized earnings method, we're going to make those same adjustments, but we're also going to add back non-cash charges, make adjustments for working capital and CapEx and things of that nature. Once we have that, our starting base point, then we're going to project income, we're going to project revenues, we're going to project expenses at a particular growth rate year over year for however long we think it's going to take for the business to stabilize. So in the example I gave before with the company introducing a product line, let's just say it took 5 years for that product line to be fully integrated into the business. We're going to project out what we believe the company's revenues and expenses are going to be for the 5 years. Once we do that, we're going to come for each year, we're going to tax affect those earnings to come up with the cash flow. Matt, you can go to the next slide. So once we've projected out sales and expenses over the next 5 years, just in this example, because the projection period, as I previously stated, should be out and go out into when the business is stable. So whether that's 5 years or 10 years, it should be whenever we think the business is going to be stable. So once we've done that and we've determined a growth rate and we projected out sales and we've projected out expenses, we've tax affected to come out with our cash flow number. In each year, we're going to discount that amount to the present value, because cash today, cash received in the future is worth less than it is worth less than what's received today. So we're going to discount each single year. And in my example, we have 5 years that we're going to discount. Now we can do that using the build-up method that Judy just went through, or we can use a WACC, which is weighted average cost of capital. So this is the build-up method is just for the future benefit that's available to equity shareholders. The WACC is for debt and equity shareholders, and it's usually for companies that have interest-bearing debt or can borrow interest-bearing debt. So once we've discounted each single year, each individual year, so in my example, we have 5 years where we discounted that cash flow that we've projected out over that 5-year period, we're going to calculate the terminal value. So the terminal value is, now we think the business is stable. This is the value of the business into perpetuity. So usually you use a modest growth rate and you calculate the terminal value the same way you do in the capitalization of earnings method. But because we're calculating into forever, we use a modest growth rate, usually between 3 and 5%. Once we've done that, we add up the present values that we calculated for each of the 5 years and the terminal value, and that's how you come up with your discount rate. That's how you come up with your value under the discounted cash flow method.
Okay, so thank you, Jasmina and Judy, for giving very general, these are very general explanations, remember, of how these approaches work. Any approach that you do for a business valuation is actually quite complex with the areas that you have to research, analyze, and assess in order to determine what's appropriate. But what we're now going to point out for you, now that we have a basic idea on how the income approach works, are a couple of the really main areas where there's usually always a difference when you have 2 different experts in a case. So the first one, probably one of the most common areas, is reasonable compensation. As you can guess, the main reason that there's always differences in certain areas of valuations is because those are the areas that are subjective. They're not based on factual data from either company records or independent third-party sources. They're based on analysis and the professional opinion of your expert. So reasonable compensation, what does it mean? In layman's terms, what I like to explain to people is when you have the owner of a business who usually works in the business, especially when we're talking about small family-owned businesses, how much are they worth? If they wanted to retire today, the date that you're valuing the business, and go sit on the beach with a drink in their hand and pay someone else to run the business and do exactly what they do to keep that business operational, what would they have to pay someone to do those tasks? So that's what the expert has to assess, and that's not a definitive number. And as you can imagine, depending on which side the expert's on, what information is available to them, those numbers can range widely sometimes. So how do you go about determining what is the appropriate reasonable compensation for your business owner? Start with an interview. That's really the first place that you need to talk with the business owner, find out their history with the company. What are their everyday tasks? What do they do? What do they not do? And take it the next step there. I would interview if there are other employees of the business potentially. You want to find out what they do, what their tasks are, compare how much they get paid to what the owner maybe should get paid for doing similar type of work. Do they have employees that handle various different levels of the company, or is your owner doing everything? For example, is he the CEO, the CFO, the COO, and the customer service representative? Sometimes you have somebody who does it all, and sometimes there's a separation of services where there's people that may help you benchmark what level of services that the owner might be performing. The next step that experts have available to them is third-party data. We do have some research and benchmarking information that's available to us. We'll take the information that we're made available to us from both the interviews and the financial data from the business and kind of compare it to what's out there in the industry, see what kind of salaries are being paid for people who are performing similar services. And we basically have to make an assessment of what is a reasonable salary for this owner to pay themselves for the appropriate services that they're performing for the business. Remember, these numbers can be higher or lower than what the person is actually paying themselves. When you have complete control of the financials of a company and you're the owner, you can pay yourself more or less than what you're worth. If the company is very profitable, they may take more out of salary than the services that they're performing. If, unfortunately, the company may be in financial trouble, maybe the owner is not taking very much of a salary at all because there's not cash flow available to do so. But these are things that you need to consider when you want to put a value on a company. For example, if a company is in financial trouble, maybe on paper it doesn't look it, but when you come down to it and you realize that the owner's not paying themselves anything, that's a problem, and that's something that has to be addressed. So if you start putting a salary on the books for the owner, maybe it's going to put the business into negative cash flow. These are the reasons that we have to look at this. And of course, vice versa. Maybe the owner is paying themselves a large salary because there's a lot of extra profits in the company. Profits are what make a company valuable and create a number to divide an equitable distribution in our divorce cases. If somebody is able to pay themselves much more than what they're really worth just for the services that they're performing, it means that the company is in a good financial state. So what we're going to do in our examples, you'll see, is we're going to actually have a range of compensation to show you how a change in this number will affect a change in evaluation. And obviously, on a simplistic basis, the higher a reasonable compensation number is for an owner, the lower the value will be, because it means that there's going to be less normalized income at the end of the day to capitalize for a value. Matt, I think you can move to the next slide.
Or Matt, Carleen, would you
for the
mind
example,
putting up the
right?
example there just so we can show them?
That's what yes. I meant to say example instead of next slide. Thank you, Judy.
No problem. Yep.
Okay, so a few little facts about our examples here, just so you know exactly the type of positions that you'll be dealing with. I'm sure you're very familiar with those. We have two experts on this slide here. We have expert 1 who's working for the husband and expert 2 who's working for the wife. In general, we're just going to say that this is a manufacturing business, which means that they make things. We're going to do the typical scenario where the business is owned by the husband and he works at the business, and the wife does not work at the business at all. So we're just dealing with a compensation number for the services of, we're just saying for the husband in this scenario. So as you can see, the highlighted line is our reasonable compensation line. The numbers apply to the same numbers that we talked about previously with Judy and Jasmina's examples. So the income trends are the same in both of these. that's where, again, we're only pointing out specific areas where things can be different. As I'm sure you can imagine, the experts could differ on what they think the normalized earnings are. And that, again, could be a seminar on its own as for why that reason is. It would be between normalization adjustments, the weightings used, if there's projections involved, all of those things could be different. So to make this more simple, we are using the same level of income for valuation purposes in both of these examples. So the difference there you can see is that expert 1 used a higher reasonable compensation than expert 2. So ultimately what that does is that reduces the normalized earnings that are subject for capitalization and valuation purposes. You can see that there's now a $100,000 difference on the pre-tax normalized income line because of the difference in the reasonable compensation. And if you flow that through with everything else staying consistent, we are now, the numbers are small for me to read, but we are now at a pretty substantial difference between the valuation values, because as you can see, it doesn't just affect the normalized income. Now we're dealing with a different tax amount, because even though the tax rate is same, the value of the taxes applied to that income is also going to change, which is going to reduce the income even further for the higher normalized earnings. As you see, it just kind of compounds. And when you get down to the bottom, Matt, if you can scroll down all the way down to the values, there you go. You can see that the expert number 1, who comes up with a higher reasonable compensation, it basically means at the end of the day that they're saying there's less profits available to value for this business, which is creating a smaller value. The lower reasonable compensation number means that there's more profits at the end of the day to capitalize and create a higher value with everything else staying the same. This, I think, it shows that obviously the bigger the difference in the reasonable compensation alone, the bigger the difference in the value. If, say, we were talking about somebody who came in and said a rate of $200,000 for reasonable comp and the other person said 600, we'd be talking about a huge difference in value here. So what you should be asking is, what sources and information did these experts rely upon in order to come up with their reasonable compensation estimates, and take it from there? How credible is the data they relied upon? What kind of analysis and trend work did they do in order to determine these numbers? That's what you would really have to focus on to try and narrow down why there's a difference. So I think we'll move on to the next level of differences that we can talk about. I think would be on the next slide then, Matt.
Okay, and Matt, if you want to just pull up, you can, so is that the weighting example there, right?
Yeah.
Yeah, you can leave the weighting example up. So I touched a little bit on this when I spoke earlier, and so we'll get into some more detail here. So the weighting really impacts the value, because, you know, what your starting point, your pre-tax normalized operating income, it's really, it's you know, those are big fluxes when you change the weighting. So if you're going to do a straight average, so you're just going to, you know, weight all of the years equally, you have to have analyzed that and make sure that those historical earnings are actually representative of what you expect to happen going forward. I think we see more straight averages when the normalized net income is similar amounts. So this example may not be the best for a straight average, because I would have a hard time saying that, you know, the company will have profits of 50,000 and 200 equally. But there could be, you know, conversations with clients and rationale behind that. There could be some cycle in this type of industry that would make the numbers move up and down, but it's absolutely something you have to consider. So you have to have an understanding if the business cycle has those peaks and valleys, what's going to happen in the next 5 years, to really be able to support this straight average. Expert 2 over here does a weighting similar to what I used in my example, where they're essentially saying, we think year 5 is much more indicative of what's going to happen in the future, and year 1 not so much. And again, they had to have, you know, they had to analyze all of the historical numbers to be able to determine what's going to happen, really what trend or pattern is existing and expected to continue. So you can see here how it affects the value. So using just a straight average, expert one comes down with pre-tax income of 130,000 and expert two comes down with 160,000. And now everything else in the valuation being equal, that swings the number a little over $100,000. So there can even be instances where we don't have in our example, but you could only place weight on 1 year based on all of your analysis, your discussions with the business owner, your industry and economic research. You could say, look, we only think year 5 is going to repeat, and you can only weight that year. That's still considered a weighted average. You're not placing any weight on those prior years. So there's a lot of thought process that goes into the weighting. There's some key analysis that are required to do that. And so when you're looking at the reports of your experts, that's certainly an area where you would want to question them on, why did you weight the years this way? Why are you weighting year 1 and year 5 the same? And listen to what those explanations are, because they really do impact the bottom line.
Right, and Judy, I think it is really an important part of the assessment when you're reviewing 2 different valuations. As Judy said, just because, let's just say that the most typical range of review time for a period for businesses is 5 years. That's what we're all most familiar with. But just because you have 5 years of data doesn't mean you have to use all 5 years in your valuation. It may be determined by your analysis and data that you use less than 5 years of that, as Judy said. And what it could also mean too is when you're questioning, say, an opposing expert, maybe after figuring out what the trends are and what's really embedded in all that information, you may kind of determine that what their answers are, maybe an average or a weighting is not appropriate, and you have to go towards what Jasmina described earlier and use the discounted cash flow model. Sometimes once you get into the details of how an expert determines to use whether some kind of a straight average, from 1 to 5 years, or some kind of a weighting from 1 to 5 years, more or less, that may help you determine if they even use the correct income approach. Because if the earnings are all over the place, maybe the appropriate way was really to project out into the future and not use an average at all. So see, all this information just compounds on everything, and it could lead to more questions. So these are just things, always keep an open mind, that pay attention to what the answers are that the expert is telling you, because it may open up doors for other questions down the road.
Absolutely. Okay, so I think Jasmina is going to talk about some of the differences in the tax rate that we touched on earlier, and we'll go through it a little bit more detail here.
Yes. So the tax rate the expert uses depends on the type of entity being valued. So we have C Corps, and we also have S Corps, which function the same as pass-through entities such as limited liability companies. So a C Corp is taxed on its earnings. And then when they distribute dividends to their shareholders, those dividends get taxed on a personal level by the shareholders. So it's something that's called double taxation. A lot of entities, in order to avoid this double taxation, choose to report as an S Corp, which is a pass-through entity. So rather than the S Corp reporting their earnings and being taxed on the earnings, and then the shareholders being taxed on any of those earnings, the S Corp just, the shareholders report the income and losses from the S Corp on their personal tax returns. So then there's a single taxing that occurs. So the issue becomes, in the valuation community, should S Corps and other pass-through entities be taxed, or how should they be taxed when being valued? And then that's when we come to this 28% versus 40% tax rate. So the 48% tax rate is the corporate tax rate. And what we see is that some experts use the corporate tax rate when there is no significant benefit to the entity or to the shareholder for them reporting as an S Corp. Or we see the personal tax rate being used when valuing the entity. Or we see some type of a tax rate that has been that's been altered to account for the benefits of being an S Corp and only having that single taxing. So can we go to the example, Matt? So as you can see here, with all things, this is the same example we've been using throughout the webinar. With all things being the same, up to pre-tax normalized income, we use two different tax rates. So expert 1 used 40% and expert 2 used 28%. So of course, the higher the tax rate, the higher the taxes, and thus the lower the after-tax normalized income is going to be. It's important that the expert is able to explain the rationale for using the tax rate that they choose, because it does have a significant impact on the valuation once you get to the end. All things being the same here, there's a $160,000 difference in each expert's value based on the tax rate.
Right. Can I just clarify one thing? So I think as we're going through, and Jasmina mentioned the corporate tax rate versus the personal. So typically in the past, prior to the new tax law being implemented, the corporate tax rate was much higher, it was at the 40%. Once the new tax law was put in place, that was lowered. So I think we have them, the 28% is representative of the corporate tax rate here, and the 40% would be more of a blended individual rate. So I just want to point that out there for purposes of our example here.
Right, and there's another, this whole issue is extremely subjective. I have actually come across some experts that have used a 0% tax rate, which really literally follows some of the court decisions that are out there. There's now a good handful of them that address this issue. The first one and the most popular is gross, I believe that everybody's aware of, and they've, the concept is there really this extra benefit to the shareholders that should create additional value when you're looking at a business because they're skipping this double taxation issue. At the end of the day, your experts should really look at the available cash flow to the shareholders, because ultimately, in my opinion, that's really what's being valued, to look at what kind of benefit they're receiving and what has really supported the marriage over the years. But it doesn't have to be the exact corporate tax rate or the exact personal tax rate. There's these blended rates that you could consider as well, given the history of the company, what's expected, and also giving consideration to the various case decisions that are out there. So again, it's just make sure that, if you have your own expert, that they're going to describe everything clearly about how they calculated it and what they relied on to come up with their rate. And if you're questioning somebody about their valuation, that's where you want to ask them about how did they determine and what support that they relied on in order to estimate that rate. But again, it's subjective. There's no right or wrong rate to use. It's really what is supported in your specific case. Okay, so now I think I'm going to talk to you briefly about how the change in capitalization rates will affect your value. Again, sticking with the capitalization of earnings example that we've been working off of, you'll see in the previous slides that it's one percentage that's going to be divided into the income in order to create a value, but there's a lot of different steps that goes into that 1% in order to calculate it. As Judy had mentioned earlier, most of those percentages are from third-party sources. Some of the experts have varying sources, but for the most part, they are in a really tight range. You want to be able to understand the different levels of the cap rate, but it is extremely complex. It represents a whole group of different levels of business and financial risk related to a company when you're considering buying it. It's trying to capture, how much more risky is this business than public companies, and then break it down further. Public companies in that same industry, and then public companies that are in that industry but are smaller, less marketable, harder to sell. And then we get down to what are the specific risks of the individual company that you're valuing. There's all of these different levels of risk that are considered in the capitalization rate. And what is the likelihood at the end of the day that the cash flow that you're calculating is going to be able to continue indefinitely, because you're assuming that this business is going to stay in business into perpetuity. So that's the general concept of a capitalization rate and the risks that it's trying to incorporate. So there's a lot of research and analysis and thought that has to go into these rates related to the business, its competition, businesses that are deemed to be similar to it, and the industry and economy in general. Again, it sounds like a lot, because it is a lot that goes into one small percentage that shows up on usually 1 or 2 pages of the entire valuation analysis, but it's pretty complex, and it's the reason why experts can take such varying positions on this percentage, and why so much work has to go into it. So again, make sure that everything is documented, supported, and explained. And one of the things that you further want to consider once the capitalization rate has been determined is you want to make sure that there's no double counting of risks, because now after all of those risks that I've just went through just very quickly, those can be captured potentially in the income stream of the company that the expert has also estimated based on the trend analysis, the weighting or the straight average that they chose to use, and just the level of income itself, what adjustments were made in order to get there. So for example, one of the most common risks that I find that people will double count when you're talking about the specific company risk piece of a capitalization rate is they say that they're throwing in a higher risk because they're unsure of the security of the cash flow moving forward. But if you've captured that in the average that you've used, because maybe you've put in a couple of really low years in the average, that really would account for, okay, well, we're going to consider that the company may have a bad year again because maybe it isn't an industry that's cyclical. You don't want to then add an extra percentage or two to a capitalization rate and make it higher, which ultimately lowers the value of the business, when you've already really accounted for that risk in your income stream. So you want to make sure that you're not counting for risks twice. So that's definitely one thing to keep in mind. You know, I could probably go on for an hour about everything else that should be considered for a cap rate, but we're not going to go there. But these are the main reasons as to why there might be a difference between the two experts. So now, Matt, if we can go to the example, we will show you how a difference in the cap rates will affect the value. Okay, so here we have, it's actually going to show up in 2 spots. And as Judy mentioned previously, the higher the cap rate, remember, the lower the value. So it has an inverse relationship there. But we have a growth rate that's showing up in 2 parts of the example, because the earnings that you are projecting, you're going to project them out for 1 extra year before you capitalize them. So we have the, it's called the long-term growth rate on that first highlight line there. And our 2 experts have used a range of 2% to 5% for their long-term growth rates for the projected year. And we've applied, in this example, again, to keep everything the same, the experts have used those same 2 growth rates for the calculation of their cap rate. Keep in mind, those can be different, and it doesn't mean that it's wrong. It could mean that the short-term growth rate for the projected earnings could be maybe higher or lower than what's really expected for the company to maintain into perpetuity going forward. A lot of times what's common is you can see a higher long-term growth rate for the initial projection, and then a lower long-term growth rate in the capitalization rate, because you wouldn't anticipate that a company is going to keep, let's say, a 10% growth rate forever. So that can be a difference there. And if it is different, it doesn't mean that it's wrong. It's not the most common thing to see in the smaller companies, but it definitely can be a possibility. But here we have the lower cap rate of 17%, that's yielding a much higher value of a couple $100,000 versus the lower cap rates at the higher cap rate with the lower value at 20%. So you can see even here, you know, a percentage or 2 on its face may not seem like a lot, but when you're dealing with valuations, and it can mean big dollars. You know, it is kind of true, the larger dollars that you're dealing with, the bigger the change is going to be. But think about it inversely too. If you're dealing with a case that doesn't have a lot of money, Even with a smaller value for a company, you have 1 or 2 point difference that could mean a lot to somebody. So you kind of want to make sure that you reconcile how your experts calculate your capitalization rate to try and really determine what they consider to do so, and that they're not just taking a position to take a position because they work for one side or the other. So I think, Matt, we can go back to the slides if you can do that.
I think that may wrap up what we have. I wanted to just add a couple of thoughts that we touched briefly on the DCF, and Jasmina walked through the components of that to give you an understanding. I do want to just point out, though, now that we're 11 months into the pandemic, as I said, I think everyone has heard the word DCF, and I do think they are going to become more, common throughout our industry. I think there's so much uncertainty, and the historical profits of the companies may not represent what's going to happen going forward. And so I do think we're going to see those a lot more often. So I don't know if you guys have any other points, but I think that's going to be something that we see much more than we have in the past. Typically those weren't relied on in court as much because there's so many assumptions and hypotheticals that go into the calculation itself. But I think in the current world that we live in, those calculations, you'll see them much more.
No, I would agree, Judy. And, I think there's so many extra things that now we have to talk about and consider when we're dealing with cash flow calculations and business valuations relating to COVID. And it makes it more difficult because, I keep getting back to using small companies as an example, but I think for the most part, that's what we really deal with the majority of the time. And the biggest problem is the lack of information and availability of data. Family-owned businesses don't maintain projections for the most part, and some of them don't know, what they're doing tomorrow, let alone how am I supposed to project out for 5 years for when a company stabilizes. So there's a lot of conversations that I think have to happen with the business owners. There are things that you can try and do to work around it. Things that I'm trying to do these days is, even if you're going to work off of the last year or two of information, but how many adjustments do you have to make? You have to take into consideration, all of these, the grants and the PPP loans that people are getting to try and help them through these hard times. How much are they really relying on it? Would the business really go under without the loans? That's a consideration. Maybe you have to adjust your risk factors there. Are they going to wind up with money that they'll be able to maybe reinvest into the company? That's something to consider. What's going to be the tax implications on loans that maybe were forgiven? You got to remember that there's going to now be, while the business expenses for valuation purposes are going to be valid, there's going to be a good handful of expenses that won't be deductible on tax returns if the loans are going to be forgiven. So you're going to have some artificially high tax rates in the next year or two for businesses that they haven't seen because of forgivable loans. And now they may be still having cash flow problems, but now they're also going to have a tax liability that has to be taken into consideration, and how it's going to be paid. So it's creating all of these other issues that need to be considered, when you're not only calculating the value, but moving forward when you're talking about how you're going to distribute the value to the parties and who's going to make sure that, liabilities are covered and who's going to be responsible for what. So, I just say, just talk it through a lot. We're all really doing this for the first time. The issues are covered in valuation books, but applying it to real life is always different. And, I know everybody hates the answer that it depends on the case, but, it's been over a year now. So obviously we've all seen these issues a lot so far. And I can't say that I've had one case that has worked out the same as a previous case. And we're finding different ways to allocate cash flow and to try and estimate what the value of the business is. And sometimes, frankly, that has meant to delay it, put it on hold and make it a piece that gets addressed, whether it's in 6 months or a year. I've had some cases that we've discussed that as well. So it's new waters for all of us. And you just kind of just keep talking it through. That's been my experience so far.
Okay, I think we might be running a little bit over. I think we have our final 2 polling questions, Matt, if you want to put those up for everybody.
That's correct. So items that affect the capitalization rate: industry, competition, diversification of customers, all of the above. Just as a reminder, we do need you to fill out the polling to get the CLE credit. Okay, we're going to close this out shortly. We're at about 95%. Okay. And everyone.
Oh, 100%.
Wow,
Good job.
Good job. And I think we have one more polling question to close out the day. And before he puts that up, I want to thank Alyssa, Vito, the whole FLEC committee for having us today. We're very happy to be here. So, and any questions, please don't hesitate to reach out to any of us if you want to follow up on anything we talked about. We put the handout materials there. We're here.
Okay, and our last question here. The best Zoom filter for your next court appearance is a cat, a dog, or Vito's mustache.
Trying to put a little humor in your day.
Matt, I'm just going to ask you, since we're waiting for the polling question to close out, were there any questions that came through at this point that anybody had?
So right now the answer is no, but we do have some time. If you have some questions, feel free to use the chat box in our GoToWebinar software. Okay, we're going to close down the poll in a moment with a slight lead here.
Wow, look at that. Vito won.
All right, we're going to start seeing people that look a lot more like Vito are in the courthouse when we finally are back.
Nice. All right, well, thank you again, everyone. I don't know if you guys have any closing thoughts, but we appreciate it. Thank you so much.
Yes, thank you for everybody who attended. We do really appreciate it, and we're always happy to help. So we do really mean it. If you have any questions about anything we've talked about or anything, please feel free to reach out to any of us. We know that there's a lot of stuff, that we covered today, and there's a lot of stuff that we didn't. But hopefully we'll be seeing you again soon, where we can cover some of the stuff that we didn't get the chance to talk about today. But we're always here to help you, so please reach out if you need.
Okay, I think that concludes it.